So today we're going to talk about real estate investing choices. Two choices in this particular video. One is, do you invest in a real estate fund? Or two, do you invest specifically into one project? And a lot of people start off investing in one project, but both are considered syndications. Both are actually raising money from other people to invest. They're just investing very, very differently. The first thing to remember is each one, the project or the fund, has equity, debt, tax, a PPM, and a business plan. So now let's take a look at the limitations and the advantages on either side. So let's say I find a 200-unit apartment project worth $40 million in Dallas, Texas that I want to buy over here. And for the down payment or in the form of equity, I'm going to need about $10 million. And in the form of debt, I'm going to need about $30 million. So combine those two equal the $40 million for the total purchase. As you raise capital, the individual investor actually is on title to this very specific project in the form of your personal name or hopefully an LLC or some entity. The profit and losses from this individual partnership then flow through in the form of a K-1 in the form of a tax on one project. When you invest in the project, you would get a PPM or a private placement memorandum that would match the business plan as well, and that would be where all the legal disclosures are. The last thing is the business plan. Now, this is specific to the project itself, and it's going to have all the information about the timelines, your investment, how they expect the project to work, the team, the leadership, whether it's a long-term hold, an exit, a refinance, whatever. That's all going to be inside of the business plan, and that's going to roll up into the PPM. The investors, they'll be on title here, and as this project moves along, it'll all flow through the tax and hit your individual return in the form of a K-1. Now let's move to the real estate fund. So over here on the real estate fund, the fund may raise up to $100 million. Now, the big difference in the equity, over here, you're raising $10 million for a specific project, and you're taking a look at the business plan before you invest. Over here on the fund side, the fund manager is actually trying to raise $100 million so they can go out and buy, let's say, 10 $40 million projects for a total of $400 million. Then match it up with $100 million of investment and $300 million of debt. Very different. So over here, there's 10 projects, and over here, there's one project. And you're relying more on the team here and their investment decisions based on their track record from the past. The one thing you got to watch on a fund is that this fund should have parameters on exactly what that fund is investing in. So you might have a fund that's investing in, let's say, warehouses or malls or retail. Another very important part on the tax is that you're taxed at the fund level. So let's say there were 10 properties in this fund. The LLC would be disregarded, and all the profits and losses of each individual 10 projects would roll up into one K-1, which of course would then go to the individual interest in the fund that you would own, as opposed to the individual interest of a project. The fund itself will have its own PPM typically, and of course each property would have its own business plan. So as each of these 10 properties were purchased by the fund manager and the team, then there would be an individual business plan for each of those for the investors to review and look at. But the fund would actually own all the 10 properties. That would be the difference. So the investors would have an interest in the fund, which would own the 10 properties. And over here, they actually have an individual interest in one property. Just to summarize, the developer would first get the project, put it into escrow, and then go out and raise the $10 million, then go out and make sure that they could get $30 million of financing. And then you would have an individual interest in that project, and you would be taxed on that one project based on what happens in the project. On the fund side, the investors all invest together, and they have an interest in the fund, and then the investment managers go out and buy as many value-add projects as they can. And just speaking from experience, when we're actually buying a property from a seller, this is a much more powerful position because the seller is asking, where's your source of equity? and we're able to say we have a $100 million fund versus we have a whole bunch of investors that typically invest with us. It's a very different, more powerful position on getting deal flow. Therefore, the investors will benefit from getting more deal flow and are more reliant, however, on the investment manager to make good decisions on the value adds like we have done over the 20 years in business. So if the investor is investing $100,000 into one project, they're into that one project specifically. But if they're investing into the fund, they have an interest in the fund, their $100,000 is actually buying a piece of up to, say, 10 different individual properties. Therefore, you've got a lot of diversification, both from a property standpoint, from a market standpoint, and of course, from a tax standpoint. All the individual projects all roll up to a profit and loss for one K1 that goes out to the investor that invests into the fund. Lastly, if you're an investor versus a project versus a fund, you should be asking the fund manager, what are your parameters for the fund? Because for us, as an example, we're investing in markets we're already in areas that we already know, and we're looking for value add. In other words, properties that have been owned a long time that have lots of upside inside of the fund. And we're obviously looking to replicate that on each and every deal that we buy inside of the fund. As always, thanks for watching. If you guys like these videos, hit like, subscribe, or hit the notification bell. I love putting these together. This one came directly from our own investors, and so hopefully I answered all your questions.